Hello, my name is JP Albano. In this video, I'm going to walk you through a financial worksheet that we put together. We call it our Financial Freedom Worksheet. And I'll explain how it works. Some disclaimers, right? Number one, this is not a guarantee of any sort of returns, any sort of performance. This purely is a tool to use to kind of experiment and see, what it would be like potentially, right? If you invested X amount of dollars for X amount of time over a period of time, and using some averages that we, in our industry, in our field here, of what returns could possibly look like, and what the tax implication of that could look like. So therefore, what is my bottom line take home profitability look like if I were to invest consecutively, maybe once or twice or three times a year in apartments as a passive investor? What would those returns look like for me? And so with that, I'll walk you through the sheet. I know it seems like there's a lot of things going on here. Frankly, there are, but you could focus really mostly on these cells here that are in this blue. The blue really just generally means that it's an input tab, so you can put data in here. So I'll walk you through this the best that I can here. So first thing is we have so the first thing here is a number two. Number two is just saying we're going to invest twice a year into a project. And so when we change this to one, this will see that it'll update the numbers here for each year. So let's walk you through some of the other pieces here. So these are obviously all the years. And we'll just focus on this kind of one column here. In year one, we put an investment amount of $100,000. This can be changed. We could put 50K, we could put 75K, we could put 100K, or even more, right? Then this is going to take the previous year. So right now, we'll just assume we put one investment per year. We're going to do it for 10 years consecutively, and we're going to put 100 grand a year. What this will do here is this is going to count the previous year's $100,000, and it just kind of keeps adding up because it's sort of a way of keeping hold of your account balance, if you will, right? Your credits. And then we have this category here, return of capital investment. So this is where we're being able to capture, when you make an investment in year one, actually, let me back up for a second. So when we invest in our multifamily apartments, there's a couple of things that we do with these. One, these are value add apartment complexes. So we have to do a lot of forced appreciation in the beginning to push up that value and then go out and do a cash out refinance at some time between years 2 and 3. Generally, when we buy these properties, we're holding them for a period of 3 to 5 years in total. So the logic in this worksheet is going to, I think we have it set for, refi in year 3 and a sale in year 5. And there's another way to toggle that. So that means is every 3 years we're doing a refinance and we're selling the property in year 5. That's why this $100,000 is coming back to us in year 5, because we're selling it. There's also, I would say, there's a variable here of fixed at 25%. So what we're saying is when we do the refinance, and we don't see one in this, this part here, because it's kind of captured in this part. We're going to say 25% of your investment is going to be returned to you in year 3, because we're doing the refi. Now, there are instances where that could be more. There are instances where that could be less. So we're picking 25% as a nice kind of safe average for people to consider. We should talk about this as well. The average interest rate, or the average annual return that we do for our deals is about 15%. That's pretty standard. I would say most multifamily apartments for value add are between the 15 and 20% range. For the sake of being conservative, we're going to pick 15%. You can play with that number if you want, and see what that does. And then the same for our average internal rate of return. We're saying it's about 18%. That's usually what people aim for. The goal is to get to this, 2 times return on your investment over the course of 3 to 5 years. And so that's a number there. I'll walk you through this pieces too. So percent of refi reinvested. If you think about how to maximize your investment, right? If you're going to put $100,000 a year into a project, in this example here, well, if you're going to get a portion of that back, in this case, 25%, if you don't need the money, and you shouldn't, if you're doing a great job in sales, if you don't need the money, then reinvest it, or use that to count towards your next $100,000 investment the following year. And the same could be said for what happens about what happens with the money that you make from your interest, right? The distributions that you get, and that's what you see in this cash return here. This is sort of this is the interest that you get, right, on your money that you're putting in each year. This is kind of for each year, and then you're adding on top of that what your cash out refi cash looks like. So you could see here by year 3 you got 100 grand. Well, geez, you could in theory take that money and go reinvest it in another deal. That's a phenomenal way of multiplying or accelerating how you can grow your cash and your wealth. You're just reinvesting it, just like if you have your brokerage account for your stocks, right? When you make a profit from a stock, if you keep it in your brokerage account, you'll be able to reuse that money to go buy more stocks, right? And you're kind of taking your profits and reinvesting it that way. Same principle here. And by playing around with this is where it gets fun and exciting. By playing around with how many investments you do per year, and for how long, and what your average investment amount, you'll see you get to a point where you really won't have to come out of pocket very much. We'll get to that in a second. So we'll continue on this example. So year 1, we're saying there's about $45,000 of annual interest returned or earned from this. There's some capital return from a refinance. There's none in that year. It starts happening in year 2 or year 3. There's a little bit of randomness into this. And so this is just kind of calculating the full amount there. Any profits from sales, we're not doing any sales until year 4 or 5. And then the same with taxes. You're not paying any taxes on any money because you didn't really make any money. But you could see in year 4 where there was some profit returned, there's a tax. Now we max this at 25%. I put a little comment here. Basically what this means is with capital gains, long-term capital gains, as of this recording in 2023, the maximum rate that capital gains can be taxed at is 20%. And that depends on your tax bracket. And you obviously want to talk to your CPA or tax attorney on that. But there could be state and other local fees that are assessed that aren't part of the federal tax for capital gains. So we use the number of 25% just to kind of be an all-encompassing number. That'll probably be the max. Maybe it goes to 26, right? Again, don't hold me to this. I'm just giving this as a worksheet to kind of play with and get an idea of how this could work in your life. And then here on this total cash flow, this is just kind of adding up all of the sums of income coming in, accounting for anything that's maybe reinvested into a deal, right? Because we said we're going to keep these at half of the money you bring back in. What's being reinvested, what interest is being reinvested, and any profits from sale that's being reinvested. And so this is kind of showing you how much annually cash flow that you're actually being able to keep, because again, we're only half of it's going back in, the other half you kind of keep. And it goes towards your counting towards going towards you. And then we average out what the average monthly cash flow is for that year. And so you could see, starting out in year 1, the average cash flow is a decent amount of money, $1,800. And that would grow up to be a significant amount of money as time goes on. And, if you think about what your goals are, and this is where I tell a lot of my tech sales investors, and even for myself, like the goal should be, or it's unrealistic to expect that in, year 2 as a passive apartment investor, you're not really going to be at a point where you're fully displacing all of your W-2 sales income, right? The goal is to slowly do that over time. Now, of course, if you've got $1 million sitting in the bank and, you pop it in 10 different deals, that's one way of doing it. But for most people, if they're going to put 100 grand in or 75 or 150, each year, it's a slow creep to getting to that point. But you get to a point where in a few years, this is year 6 or so, where, you have the potential of earning a lot of money per month. And that could be enough to offset what you were making on your W-2 sales job. Or it's so much of an offset that maybe you're in a position where you can leave your sales job and do something else. And then that, the idea of getting to freedom is really important, because ultimately that's what I wanted. I started out in apartments because I wanted to kind of break free of how much I was paying in taxes from all my commission checks. And you can learn more about that on my YouTube channel. But really what I discovered was what I was looking for was freedom, financial freedom. I wanted the ability to have options and optionality, and, being in a, earning a high income in sales was great, but it also was very limiting. And I realized if, after a certain period of time doing that for a while, you kind of get over that. You want to be able to do something else, but you can't because you're making such good money. So, being able to invest in these low risk assets like apartment complexes where there's always demand for that, just made a lot of sense for me. And you can mitigate a lot of risks by making smart investments, doing, picking the right locations and working with the right sponsors. And then you get to a point where, if you had $15,000 a month coming in, that it didn't require you to be active on that. You could do whatever you want. You could kind of retire in the Bahamas with this kind of money, right? Or Thailand, man. If you had $15,000 a month in Thailand, you're king. Okay, so what does this mean? So in this particular scenario where we put in one investment per year, we're investing for a total of 10 years, right? And half of our cash is going back into the deals. We're coming out of pocket $263,000. The equity remaining, there's $200,000 still left in the deal for us because this model only goes out to 20 years. And basically what this means is there was a gross amount of $2.3 million coming back to us. We paid about $369,000 in taxes, and the net cash is the bottom line take home that we were able to bring, which in this case you can see is $1.7 million. So we put in 263 and we turned that into 1.7. How do we do that? Because it's a 652% total return of your cash. And you can play with the model here, right? So some notes of kind of caution on how this works. And actually this might be a casualty of that. So we have to be a little bit careful on how much we're reinvesting because the model will kind of break if you 100%. Now you could in real life, right? In real life, you absolutely could take 100% of any any proceeds that you make and reinvest in the deal. There's no reason not to do that. And if you can afford doing that, I would encourage you to do that because that really is a supercharge. It's a way of supercharging how much you could put into these deals and have that grow for you. The problem is for the model to work because it's very rudimentary. It's complex, but the model has to work within certain parameters here. And we don't want to have is negative out of pocket money coming in because that's not money going in, it's money coming out. It's a weird thing. So here what we could see here is we got $400,000 coming in, 1.6, being able to come out. So don't get too aggressive with this. If you put this to 100, for example, 100%, 100%, 100%. We're at a point in year 5 where out of pocket money needed, right? In order to meet this $100,000 of obligation that you're going to reinvest each year. Well, you had so much coming back to you that you're getting paid $107,000 over what you have to put in. That's not possible. So keep this in this 30 to 40% range. And see what that does for you. And the other thing to play with is, play with the investments per year. If you could feel comfortable being able to put in, call it $75,000 per year for 10 years, twice a year, what does that do for you? That's $1.8 million, right? And again, you could kind of play with these values here and see what that does. Does the 45, goes to 40, 45. Now we're at $1.8 million, right? And what happens if I go to 150 a year, twice a year? $3.7 million that you've made over the course of 10 years. So the other piece too is there is an element, and I'll just kind of go on behind the scenes. If you go over here, there's an element of you can actually see how interest is earned in the table here that we use here. But the way this model works is there's one of two scenarios that runs. There's a predefined randomness that works where refinances happen in year 3 and sales happen in year 5, but you can also switch it to completely random. The only problem is every time you change a variable, the model will change. So, you won't be able to see kind of apple to apple. If you change this to 39%, like here, we're at $4.4 million. You change it to 39%. That may or may not change the number here because it is set to pick random times when the refinance happens and when the sale happens. So in one scenario, when you run this, it might do a refinance in year 2. Another scenario, it might not do refinances until year 3 or 4. And so it'll change things. You'll see that. So we recommend really just kind of keeping it on refinance year 3 and year 5. and otherwise just kind of playing with the other variables here. And of course, you can obviously play with, doing it 3 times a year, see what that does, $10,000. And just kind of get an idea. So hopefully you found it to be useful. Let me know what questions you've got, if you got any, in the comments below. You can also reach out to us on our website, www.significantlc.com. That's the word significant without the T, lc.com. Or you can find me on jpalbano.com. Thanks so much. See you soon.